About the decision that has been taken today. I'm Guy Johnson in London. Let's talk about that decision and the detail and the nuance that goes with it. So here are the basics. The Bank of England has left its key rate at a 16-year high. It remains at 5.25%. However, things are starting to develop. The MPC voted 7-2 for no change. So the Deputy Governor, Dave Ramsden, has joined Swati Dhingra in voting for a rate cut. So we now have two on the Bank of England's MPC that are voting for a rate cut. In terms of the inflation forecast, because we get more detail at this meeting, we have seen the inflation forecast reduced over the forecast window and the growth outlook has been increased. You are looking at the reaction in the British pound. We will continue to track this for you as we get into our press conference, into the press conference that we are going to bring you. That is going to be delivered, of course, and led by Andrew Bailey, but we'll hear from some of the other members of the MPC in terms of their outlook as well. There's plenty of ways you can digest and work your way through this whole process. We have a T-Live, a top live function that is running on your Bloomberg. You can also find us, of course, on Bloomberg Television. The YouTube channel is also taking this coverage as well. We just showed you what the market reaction was in sterling. Not a massive reaction today, I would argue, in UK assets. So you've seen a leg lower in sterling. I think that the indication there is that maybe this was slightly more dovish than anticipated, but it's not a big move. 2-year gilt also sending a similar signal as well. Some of the more interest rate sectors on the FTSE 250 have benefited from this. So you are looking at an increase in terms of the housing sector. That has looked fairly good. And we'll be seeing some of the more service sectors, I suspect, as well, looking better as well. In a moment, we're going to be joined by Bloomberg's head of economics and government. That, of course, is Stephanie Flanders. But let's get an update, first of all, on the details of the decision from our UK correspondent, Lizzy Burden.
Well, Guy, this is a dovish hold. Soon but not yet is the Bank of England's message here. As you say, the market has taken this message slightly dovishly. Weakness in sterling and a change to pricing of cuts from the market on BOE cuts in future. So before it was only a 40% chance of a June cut, now that's a coin toss. But here are the dovish signals. First of all, as you mentioned, the vote split. Dave Ramsden joining Swati Dhingra. He had made a dovish speech recently, and it's interesting because the man's got form in leading the pack. In November 2021, he voted to hike before the majority followed in December, and then in both February and September 2022, he voted for larger hikes, and then the rest subsequently followed. The other sign, the forecast. Now the Bank of England sees inflation at 1.9% in second quarter 2026, 1.6% in the second quarter of 2027. In other words, below the Bank of England's 2% target. So that suggests that the Bank of England thinks the market before this decision was being too cautious in its pricing of rate cuts, and they've responded to that. Finally, the guidance. They've kept the line that policy could remain restrictive even if bank rate were to be reduced, but they've added that they're going to watch the forthcoming data releases and how these inform the assessment that the risks from inflation persistence were receding. So now we look to that press conference, and it's going to be interesting whether Andrew Bailey follows Christine Lagarde's lead in specifying which data points they're watching to give us a bit of a nudge, nudge, wink, wink as to whether it's going to be June or August when the cuts start. But I don't think they'll be as forthright as to tell us how many cuts we can expect, like the Riksbank did yesterday.
Lizzy, thank you very much indeed. Yeah, I wonder whether he needs to be a bit more explicit and why he's not being more explicit in terms of the guidance he's giving us when those rate cuts will be delivered. Stephanie Flanders, head of economics and politics at Bloomberg Economics, joins me now on set. Dovish? How dovish?
I mean, there was quite a lot of dovishness kind of priced in, I think, as we've seen. So I would say it's about as dovish as we would have expected. And the sort of signs of dovishness on the change in the Dave Ramsden vote, again, more or less in line with what we would have expected. But I think that the forecasts leave a lot for the governor to talk about and perhaps lean more dovish in the press conference. They do have, as Lizzy mentioned, you now have this forecast that, you know, in the old days, if you were looking at a Bank of England's forecast that showed inflation clearly below target in 2 years and even further below target 3 years out, that would be basically explaining a rate cut.
Yeah.
So there will be a question, I think quite reasonable question, is given these forecasts, why are you not cutting this month? What are the uncertainties are you seeing? I suspect the debate will be potentially more around that than any kind of signalling, particularly around given months, because the institutional memory of the Bank of England at the moment is that they've been burned by when they've tried to be too specific about what's going to happen.
Why can't they? The data supports the view that this is an economy that probably is in need of policy easing. Policy, even with a reasonable amount of easing, would still be restrictive. Why can't they be more explicit in terms of the guidance they can give to the British economy?
I guess the question is, what do you gain from tying your hands, would be probably what they were asking themselves in the bank. I mean, if you have signalled, and they've signalled in the statement has not particularly injected an extra dovishness in terms of the way it's talking about the restrictiveness of policy or anything else. It's more or less the same. I think if you're clearly they've never been quite as clear as Christine Lagarde in highlighting, those three sets of things that the governing council's looking at. So that's more of a sort of philosophical difference between the two banks. But what we crucially have seen here, and we think is actually going to continue in the data, and they're going to continue to reduce that forecast, is this much faster than expected fall in inflation in the second half of this year. And I think what they have accepted is that logic that, just as we saw wages and domestic price pressures follow the headline rate up kind of faster than we expected. The assumption of the Bank of England had been it would be slower coming down than going up, but they're admitting in this report that actually maybe it will be quite quick coming down as well, and that could help them further down the road.
Let's put some cards on the table. Bloomberg Economics has got some quite aggressive rate cut calls for this year. So why is the Bank of England, do you think, lagging? You've just laid out some of the reasons behind it. How quickly could we see it catching up to where you expect them to ultimately be?
I think if you look at this, it's more that they still believe the market is lagging and has been perhaps responding to the Fed, has jumped to a view that there would only be 2 rate cuts this year. We've been on 125 basis points throughout this period worth of cuts through to the end of the year. And speaking to our chief European economist and the chief UK economist, they are sticking with that call today on the basis of these new forecasts, because they think the Bank of England's forecast is basically moving their way.
There is an argument that says that, particularly within the service sector, a lot of what has happened with minimum wage, etc., is going to mean that wages remain stickier than anticipated, that government policy is actually kind of keeping things more elevated than would have originally been anticipated. How are you folding that into your thinking?
I mean, I think the crucial thing is we have seen the typical wage growth go down quite significantly. So it was at 8, that was when everyone was particularly worried about that level being built in. It's gone down to 6. I think you're right that the sort of steady state growth, if it continues to be at odds with what we think productivity growth is, that is obviously an ongoing concern. But remember, policy is pretty restrictive now. And I think that's, again, what we might expect the governor to talk about is, even if you saw, a series of rate cuts over the next few months, you would still have restrictive policy bearing down on those wage growth.
OK. Long and variable lags. So if we get rate cuts, if you get 125 basis points of rate cuts, how quickly would the economy respond, do you think? How sensitive is it?
Well, I mean, we know that certainly in the short term, in the sense, where inflation is going to be for the next 6 months, very much baked in. I think the signalling for whether it's the housing market or other parts of the economy, can come in via the financial markets sooner than that. But I think, we would still be looking, as they would always say, at a sort of, 1 to 2 year time frame for the impact.
In terms of, if there was an election, would that muddy the waters? Clearly, this is a conversation that's happening over in the United States about how the Fed can manage that process. It's trying to remain apolitical. There's considerable calls from Westminster to cut rates at this point in time. If the Bank of England was perceived to be cutting aggressively at this point, would there be any kind of calls from Westminster that they are listening to the narrative?
I'm sure the first answer to that was we would not be looking at it at all. I mean, there's a sort of small p politics of how the governor is considering his own position and some of the criticisms that the Bank of England's had, how much they feel it's sort of justified, the criticism that they faced even from some government ministers. But the sort of capital P politics is a bit easier here just by the sheer extent of the poll lead of the Labour Party. You have a very, very too close to recall election in the US, where the perception is, particularly on the economy, where Donald Trump seems to have sort of the upper hand in terms of, people associating a lot of bad economic news with Joe Biden. I think it feels like a much more sensitive place to be if you're the Fed, particularly since the strength of the economy means they're not going to be cutting potentially over the next 6 months very much or at all. Whereas here, sort of, I guess the feeling is, how much difference could it possibly make when the Conservative Party looks so unlikely to win the next election just on the basis of the poll?
Does make it easier. Let's talk about plumbing. The Bank of England is currently involved in active QT, which very few central banks are doing. There are now, and in some ways this is a similarity to what we're seeing over in the United States, there's slight concerns about what's happening in the money markets a little bit. There is a strong demand for cash, which the bank's QT policy is beginning to squeeze an impact on. Are we going to see changes? I haven't actually seen anything.
I think there is. So I believe, it depends on what aspect of it, but it's September 19th, around there, is when they're going to restate or state their ongoing policy, whether it's going to change in terms of how they're treating the sell-off of the bonds, running down of the balance sheet. Ideally, to preserve, they want that headroom to be able to respond to a future crisis. But I think, as our senior reporter Phil Aldrich has pointed out, there are fiscal implications as well as market implications for how fast they're moving on QT.
So that's something we can park until significant.
Well, on the long term, I say there may be things they can tweak at this time, but my understanding is the sort of overall strategy they will only restate in September.
Right. And would the expectation at that point be that they would go more runoff than active?
Potentially. I mean, that's obviously something which has a fiscal implication as well. So, yes, the Treasury would be quite happy to see the implications of that, because it could mean more room for tax cuts potentially.
In terms of what the overall cycle looks like, 125 this year. What about next year?
Well, I should say 125 is still not what you would expect looking at these Bank of England forecasts. That is where Dan Hansen, our chief UK economist, is. It's not. I suspect the market's not going to follow us quite that far, but I'd be surprised at the end of today if we didn't see more than 2 rate cuts built into the market, but built into the curve. But I think you would then you could have a debate about are we moving faster to a similar endpoint, or are we actually expecting rates long term to be lower?
Stephanie, great stuff. Thank you very much indeed. Fantastic work from Stephanie and the rest of the amazing Bloomberg Economics team. Pretty much getting this one spot on. So the governor is just being introduced. Let's take a listen. This is the press conference from Andrew Bailey.
Today we've held bank rates at 5.25%. The big global shocks that caused inflation to rise have faded. And monetary policy is working to bring inflation back towards the 2% target. Inflation has now fallen to just above 3%, and we expect it to be close to the target in the coming months. And that's encouraging. But we are not yet at a point where we can cut bank rates. We will consider the forthcoming data releases as part of our assessment of for how long bank rates should be maintained at its current level to be sure that inflation will fall all the way back to the 2% target and stay there. So let me start with the outlook. We've had relatively few UK data surprises since our previous monetary policy report in February. Economic growth was weaker than we expected in the fourth quarter of last year, but we think the first quarter of this year has been a bit stronger, which will leave the level of economic activity broadly where we thought it would be, as expected. 12-month consumer price inflation, which has just come up on chart 1, fell from 4% in December to 3.2% in March, its lowest rate since December 2021, 0.1 percentage points higher than we expected in February. The decline was spread across food, core goods and services. Energy prices have also continued to contribute negatively to the headline inflation rate. And as a lower Ofgem cap on household energy prices has come into effect in April, we expect headline inflation to drop further to a level very close to target in the next few months. But we then expect it to edge up again in the second half of the year as the negative contributions from energy prices fade. Now, this absence of data surprises is an indication that we're now getting back to more normal times, at least compared to the highly unusual period we've been living through with a global pandemic and a major war in Europe. Risks to the global economy remain, including from the conflict in the Middle East. But so far, economies have adjusted to withstand those risks. Global supply chains have held up, and energy prices have moderated. Chart 2 provides one illustration of how the outlook has become more predictable, at least in the near term. It shows the evolution of our 6-month ahead inflation projections, that's the stalks on the chart, and compares it with the outturns in the data, that's the blue line. For some time now, inflation outturns have again come in close to the near-term projections. Turning to indicators of inflation persistence, the picture is much the same. Service price inflation and wage growth have both been a little higher than we expected in February. That should certainly give us pause for thought, but we should not overinterpret these surprises either. There will always be some ups and downs in the data, and the news we have had recently has been well within the volatility we should expect in normal times. In summary, on the data of late, there have been relatively few surprises. A little more strength on inflation persistence than expected, but well within the normal margins of variance. More data will help us to extract the signal from the noise and help us to judge whether or not we are on track to bring inflation back to the 2% target sustainably. And more data will help us to assess if we are sufficiently confident in that process that we can start to withdraw some of the restrictiveness in the monetary policy stance. Before our next meeting in June, we will have 2 full sets of data for inflation activity and the labour market, and that will help us in making that judgment afresh. But in saying that, let me be clear. A change in bank rate in June is neither ruled out nor a fait accompli. So I'll turn now to the key forecast judgments. In our current assessment of the medium-term outlook, the Monetary Policy Committee has been guided by 3 key forecast judgments, which have just come up. These judgments and the risks around them are described in detail in the report that we've published today. The first key judgment is that GDP growth is expected to pick up during the forecast period, following modest weakness last year. The second is that demand will gradually fall short of supply, leading to a margin of economic slack. The third is that second-round effects in domestic price and wages will take longer to unwind than they did to emerge. So I'll briefly comment on each of these 3 key judgments in turn. First, on growth. We think that the stance of monetary policy will weigh less on economic growth over the next 3 years. We also expect economic growth to be supported by an increase in the population and by some pickup in productivity. Fiscal policy will have some effect too. And the continued unwind of global shocks to energy and imported goods prices will boost real incomes. Second, on demand and supply, we think that the current balance between them will gradually turn into excess supply. Despite picking up during the forecast period, demand growth is expected to remain weaker than supply growth, in part reflecting the restrictive stance of monetary policy. This also means that we expect unemployment to rise somewhat over the next couple of years, but by less than we had been expecting previously. Third, on wages and prices. We think that headline consumer price inflation will edge up again in the second half of this year. The negative contributions from energy prices will fade, while domestic inflation pressures are likely to persist for longer. That illustrates why we monitor indicators of domestic inflationary pressures very carefully. We've made 2 important adjustments to our inflation judgments. First, we now judge that a greater proportion of the effect of past increases in import prices has already passed through to consumer prices. This is not least because the rise in import prices was associated with acute shortages of many products. What this means is both that the past rise in inflation is easier to explain and that external pressures are likely to be somewhat weaker over the first half of the forecast period. Second, it's now the MPC's best collective judgment that second-round effects on domestic prices and wages will fade slightly faster than we have previously assumed. There remains considerable uncertainty around this judgment, however, and I should note that MPC members do hold a range of views about it. Let me just make one observation. Second-round effects on wages and prices emerged at least in part in response to falling real incomes, as households and businesses understandably sought to resist an erosion of their real income and profits. But real incomes are now growing again. As the chart that's now up, chart 3 shows, aggregate real income growth is about as strong now as at any point over the past decade. That is good news in itself, of course, and higher real income should also help such second-round inflationary pressures to ease. This takes me to the medium-term outlook for inflation. Chart 4 shows the MPC's modal or most likely projection for consumer price inflation conditional on the market-implied path for bank rates. In this projection, inflation increases from around the 2% target in the second quarter of this year to around 2.5% by the turn of the year, before falling back to 1.9% in 2 years' time and to 1.6% in 3 years. This projection reflects our view that we're making very good progress in returning inflation to the 2% target, that the restrictive monetary policy stance is working. In fact, conditional on the market-implied path for bank rates, the projection suggests that inflation could fall below the inflation target towards the end of the forecast period. So let me turn to monetary policy. With the progress we've made, to make sure that inflation stays around the 2% target, that inflation will neither be too high nor too low, it's likely that we will need to cut bank rate over the coming quarters and make monetary policy somewhat less restrictive over the forecast period, possibly more so than currently priced into market rates. This would be consistent with ensuring that inflation does not fall noticeably below target at the end point of the forecast. But that judgment is one for the future. It really depends on how the data evolve and how that evolution affects our assessment that the risks from inflation persistence are receding. We have no preconceptions about how fast and how far we might cut bank rates. Instead, we will continue to look carefully for evidence that the outlook for inflation is consistent with the 2% target, given the decisions we have already made. And we will reach a new decision on the appropriate level of bank rate based on the evidence at each meeting. Finally, it's Ben's last MPC press conference today, though not his last meeting, that will be in June. Today is his 40th press conference. His 52nd monetary policy report, because his first 12 were as an external committee member, and his 127th MPC meeting. These are impressive numbers. It's impressive punishment. But the numbers only tell a small part of the story. Ben, you have been an excellent colleague, and we will miss you greatly. And I'll just end by noting that the fact that Jürgen Klopp has decided to step down just as your term expires is, I am told, entirely coincidental. So with that, Dave, Ben and I will be happy to take your questions, and Ben will be happy to reminisce as you wish.
I think that means Ben's taking all the tricky questions. Let's start with Sam and then Faisal, please.
Thanks, Sam Fleming with the Financial Times. The new language that you put in the minutes, or the record of the minutes, underlines the importance of, as you said, of the upcoming data releases. Governor, would you feel comfortable advocating a rate cut as soon as the next meeting if the data outturns are in line with forecasts? And a question also for Dave Ramsden, if I could. Could you talk a little bit about why you decided that an immediate cut was necessary? Are you effectively taking the judgment that the bank is inflicting unnecessary damage on the economy by keeping rates at the current level? Thank you.
Well, I'll talk about the next week. I chose my words, as you can imagine, quite carefully in saying that it's not a fait accompli and it's not ruled out. I mean, nice question. You know, if things come exactly as we forecast them, what follows from that? And the point I would make is this. We added a sentence to the monetary policy statement in the last paragraph, and what that essentially says is that we will consider the data releases that are coming up, and I'll stress this point, how they inform the assessments of the risks to inflation persistence and whether our judgment that those risks are receding, that's the language we used, and receding slightly faster than we had assumed, holds. So certainly speaking for myself, we will obviously take the data, but even if the data are exactly in line with what we forecast, we will then have to reach a broader judgment to say, does that mean that those risks to inflation persistence are receding, and how do we put that into the context of the view we've taken today? So that's, I think, the way I would frame it. I certainly want to be clear, June is not a fait accompli, but each meeting, is a new decision. Each meeting is genuinely a new decision. We are genuinely evidence-based, but you have to put that evidence into context, and that's what we will, of course, do. Dave.
Thanks. And I think it's worth stressing, I'm here today along with Andrew and Ben to answer questions about the MPC decision, the forecasts, wider developments in financial markets. Andrew's just emphasised, that there's a range of views on the risks around inflation persistence and the degree to which those have receded. That was central to my vote, but I'll have an opportunity to say more about the underpinnings for my vote in the next few weeks. I've got speeches coming up, so for now, I'm afraid, rather than sort of pick up on the language you used, Sam, I'd just flag Swati and Mai's position is set out in para 22 of the minutes, so that gives you a summary for now. I hope that's okay.
Faisal.
Thanks, Governor. Faisal Islam, BBC. Are you frustrated by how the market interpretation of where rates are going has been kind of led by what's happening in the US, stickier inflation there, some words from your colleagues in the Fed saying that rates will have to go up there? You seem to have avoided following down that road. And can you clarify, you said something in the opening statement about market rates and that you might cut more quickly than is assumed. Can you just clarify what you were saying there?
Yeah, I mean, on that, I'll take them in reverse order, Faisal, because it's a good question. Look, I mean, I think the point I was making is this. You can obviously see that our forecast ends up at 1.6%. That's the number I gave. And the point I was making is, look, if the world were to pan out exactly as we expect it to, which, of course, let's be honest, of course it never does, but because things happen, but let's say it did, then I think that obviously we would face the question, have to sort of confront the question: does that suggest that the path of monetary policy would be less restrictive than the path here, which remember is conditional, this forecast, on the market curve? And that's the point I'm making. I think at that point you would have to obviously address that question because you would have inflation ending up below target. So that's the point I make. Now, to come to your first question, which in a sense frames the context for it. I mean, it's certainly true when our staff do the sort of the analysis and do the decompositions of market movements. The market movements of late in recent months have been dominated by movements in the US markets coming over to other markets, including our own. I've said before, I think I said in Washington when I was making remarks about 3 weeks ago, that to my mind, the inflation dynamics of the UK are different to the US. The US is facing a different situation. It's got stronger demand, and therefore I think it is important to make that distinction. I think we've seen some, response in markets to that of late, where there's been some movement, some decoupling. But I think it is a question that I think we have to keep posing, because we certainly do observe that I would say the inflation dynamics do look different in the UK, certainly.
Let's go to Marine and then Joel.
Hello, Mehreen Khan from The Times. A question about the forthcoming data and actually your tolerance for volatility. If data is not coming in exactly in line, are you more inclined to see these as bumps in the road rather than telling you something else about what's going on in the economy? For example, the Fed has sort of rode back on its idea of bumps in the road and thinks there's stronger signals coming from its inflation signals. And just on the skew of what's actually coming up, given your frustration, your continued frustration with what's happening with the ONS's labour market figures, are you less likely to see any signal coming from the labour market and rely much more on the inflation data for April and May compared to the labour market report?
Well, I mean, that's a good question. Ben will probably want Sean to come in on this. I mean, there is always data volatility. I mean, I think it's important to note that, short-run data are always volatile in that sense. So you always get some ups and downs. And what we spend a lot of time doing in our meetings is sort of, in a sense, trying to extract the underlying signal from the noise, if you like. And of course, we get a lot of other inputs, including our agents who are, giving us every time give us their own new assessment. And we will do that because, if I had to predict something, I would say when we get to the next meeting, what we will find is that, some data are sort of in line with what we thought and some are a bit at odds with what we thought, and then we have to sort of try and work out whether there's a particular story that explains that. I'm going to give you an example at the moment, which I think is, quite a good one, actually. So one of the things that, certainly again, I look at quite closely is the pass-through of costs into prices. So it's interesting if you look at the last PMI survey that came out a week or so ago, you saw a stronger picture for input costs than you did for output prices in the producer sector. Now, I think that's a very interesting potential bit of data, because what it sort of chimes with is discussions I certainly have when I go around the country, which is, particularly when you look at something, take something like the national living wage. We can observe what it is. The question is it being passed through? That PMI data would tend to suggest it possibly isn't. It tends to fit with stories I've heard around the country of companies saying they're probably a bit less likely to pass these things through at the moment. There's more pressure on margins in that sense. So that's the stuff we have to always do. On the ONS, Ben will come in on this. I think, we've included a box in the NPR on the state of play. We can't not look at the labour market. And by the way, we're talking there about quantities. I mean, the wage data is a different survey, not in the same box in that sense. We can't not look at it. On the other hand, I mean, I'll give you one example, which is highly relevant. It's very hard at the moment to know whether participation has gone up or down, and that's challenging.
Andrew referred to trying to extract the signal from the noise, and in that process, roughly speaking, the weight you put on any single indicator is inversely proportional to its variance. So some indicators are noisier than others. You're right to say that the quantity numbers in the labour market are more uncertain than usual. The low response rate means the sampling error is higher. Similarly, as it happens, the AWE, the official wage data, which don't have that same problem, the response rates, survey of businesses, are pretty high, but the numbers themselves are very variable from month to month. So for my part, I'll probably look a little more closely at services inflation than wages, at least over very short periods of time. That said, Andrew's right, we have quite a lot of other indicators that we look at as well. We've got plenty of surveys for wage growth, including from our agents, from other private sector firms. Similarly, on employment, we have quite a bit. There's a nice graph in the NPR trying to get at what might have happened to unemployment, or at least to supplement the LFS estimates by using survey data. So I think it would be wrong to imagine that we only look at the official series. And it's precisely because they too can be quite variable from month to month or uncertain that we need to look at a whole range of indicators.
The only point I'd add, and I really would recommend looking at the box. It's box D on page 58. I mean, I know a lot of you have written about it, but it gives our latest assessment. I mean, one other thing that I think has got a bit less attention is that in the past, the ONS, as part of the LFS suite, used to publish important data on labour market flows. So those, they're if you like, they help you assess the transition rates between different states in the labour market. And those, you could discern and infer something from those flows for more real-time data. So those data are still completely suspended, which adds adds to the challenge. And I think to Andrew's and Ben's points, therefore, we have got a lot of other data to fall back on and a lot of other sources, but we are therefore having to put more weight on things like what the agents are telling us. We're really lucky to have the agents network to enable us to do that. It gives us a more systematic take on those kind of more case by case visits and the like. But I think it is going to be really important. I mean, the ONS has a plan of work which it's already implementing, but there remain real concerns with the LFS, and it's really important that those are dealt with.
Thank you. Joel Hills from ITV News. I have two questions. The first on who goes first. You've made the comment that inflation dynamics in the UK are different to the United States. There is still that perception in markets, isn't there, that the Fed is likely to go first? Are you saying that that perception is wrong? And secondly, you've said previously that one cut in bank rate is likely to still leave it in restrictive territory. The markets are now betting on 2 or 3 cuts before the end of the year. Would that still leave interest rates in restrictive territory?
Well, first of all, there is no law which says that the Fed must move first and everyone else, including us, moves afterwards. I mean, that is not a law. Moreover, as you know, we have a remit and a target which is related to domestic inflation in the UK. Now, obviously, we take the world we're an open economy, so we take the rest of the world into consideration. But we take it into consideration insofar as it affects inflation in this country. So let me be clear, there's no law which says that we can only move after the Fed moves, and that's not something that ever gets discussed in the MPC. What gets discussed is the impact of the world economy, including US monetary policy, on our remit and on our achieving our inflation target. So that's, I think, very clear. On the question of restriction, yes, I mean, I still hold to the view. I mean, if one cut, I mean, I think we're probably assuming it's a small cut, obviously, would still leave us with restrictive monetary policy. You may remember we've been using the word restrictive now for some time, and it is, in a sense, the path thereafter and how we adjust which will be taken into consideration. But it's not a question of one move takes us from being restrictive to not restrictive.
Yeah, I think someone said this is my 40th press conference. I think, is it right, you've probably asked about where neutral interest rates is in 38 of them, let's say. So we feel confident enough about the range, a reasonable range for neutral, that we can say we're in restrictive territory and would remain so with one cut. But that doesn't mean we have a very precise view of where we're going to end up. And it's something one learns over time. And in reality, the way policy is set is it responds to the data that we think are telling us about forward inflation. This is my view at least. And then we look back later and say, it turns out this was the neutral rate of interest. But what we don't do is form a strong or too strong a view about that in advance and say, we certainly do work on estimating this number. But I think it would be misleading to give you a single number and say, yes, we're definitely heading to that point.
But I'm not asking where neutral is. I'm asking if bank rate at 4.5%, that's still restrictive, right?
Well, if you look at the numbers, I think we put I can't remember when it was, Dave will remember better than me. It's probably towards the upper end of a reasonable range. But I don't think we want to pre-commit to some number. And as I say, the way it will actually work is we will respond to the data that we see that tell us about forward inflation.
Let's go to Helia and then Larry, please. Right in the middle. Yeah.
Sorry, long journey. Helia Ebrahimi, Channel 4 News. Governor, you said that June isn't a fait accompli, but can I be crystal clear for all mortgage borrowers, companies at home? You say that you have to trust that inflation is falling back to the target 2%. But that's exactly what your forecasts say. It's falling not just to the target, but below the target. Should we not trust your forecast? Do you not trust your forecast? We're forever being told by the ONS that data is volatile and we should ignore it. How much standing should we put your forecast in?
Well, I'll make 2 points on that. First of all, the key phrase is that inflation reaches the target sustainably and sustains its hitting the target. The second thing is, and sort of goes back to the press conference we had a few weeks ago with Ben Bernanke. All our forecasts are conditional. I mean, I think we have to. I know we have to keep emphasising this point because we don't make unconditional forecasts, and of course the world changes, so that we have to keep coming back to this question, and we keep having to come, as we do, have to come back to the question: do we think that we are going to hit the target and sustain that point? Now, as you can see from our forecast, in the very short term, we may hit the target in the next, 2 or 3 months, but we don't think it will stay there. We think it will. But the question then is further out. And further out, of course, there are many things that condition further out. I mean, there are many assumptions. Many things can change. We have to continually reassess the view. Do we think we're going to get there and it's going to stay there? And the point I make is this. It comes back to the key the sentence that we've included in the MPS. We think the risks to inflation persistence are receding, but we do want to see more evidence to be sufficiently convinced of that before we cut rates. That's the view I hold.
Andrew, can I
yes, do.
Just one small point, which is one of the reasons we think that the persistent risks are fading is because policy is restrictive. Okay, that's an important point. And the fact that you anticipate that the likelihood is that rates will fall doesn't mean you have to bring them forward and do it all now. Andrew made a remark about the shape of the curve in his introductory remarks and the overall forecast. That tells you that given everything else we're assuming in the forecast, you might think the curve is, a little high. To be consistent with those assumptions doesn't mean that the curve's unreasonable. It just means that our assumptions. Yeah, but that's a statement about the average level of interest rates over the next 3 years. It's not about the statement about today's interest rate. And the committee does need to be more confident before it can start following any declining path. But the underlying point is that the reason in the forecast that inflation falls back sustainably to target and then, as you say, slightly below it, is because policy is restrictive.
Larry, who's right behind you there.
Larry Elliott of The Guardian. There's quite an emphasis in the monetary policy report on the money growth figures. I just wondered whether you could explain why that was. It seems to be, much more prominent than previously. And more particularly, does that suggest the MPC thinks that it missed some signals from the money supply figures when inflation was going up? And does it suggest that there is a message from the money supply figures now that they are quite weak in the current configuration of events?
Well, I'll make 2 points on that, Larry. I mean, there's also been a lot of commentary on this. In terms of the MPC process, I mean, we've always looked at the money figures. I think Ben has said in the past, they are much better as what you might call medium-term indicators than they are short-term indicators, but we always look at them. I think in the light of the commentary outside, I think we felt it would be helpful to perhaps, set out in a box how we look at them and what we look at and what role they play. And I think that's useful to do. On the current situation, I'd sort of put it as follows. I think we've used in the past a chart which showed that, particularly for the household sector, the rate of money growth did rise above the trend, the longer-term trend line during the sort of the COVID period, particularly. No great surprise there in terms of what was going on in terms of household spending. But what we've seen in the last year or so is that it has weakened and come back to that trend line. Now, interestingly, but I don't want to read too much into this, I think it's an interesting sort of latest development. If anything, now it seems to be stabilising. So that having come back to that trend line, it's not at the moment going below it. And I think that's an important and interesting piece of evidence which we take into account. Now, how much we read into that, well, that's the judgment we always have to make.
I was just going to add on that, and we try and keep the NPR to a sort of manageable length, but try and put things of interest in. This time round, it was certainly important, I think, to include, as well as the LFS box, this box. And as Andrew's saying, I mean, it is, there's clearly a pretty long-term relation between nominal economic activity and money, but that's over years and years. It's not something where you can extract a short-term signal from. There has been this interesting recent development, as Andrew says, and so looking at whether there is a signal in that recent weakness in money growth, could that be telling us something about, something more fundamental about nominal spending? We do think, I mean, this is a sort of view we've been developing for a while. It seems more likely to be consistent with the unwinding of those pandemic era, strong money balances, particularly in households where you had that sort of overhang of money. So that's our assessment, but worth sharing, we thought.
Ed and then Phil, please.
Hi, Ed Conway from Sky News. Governor, doubtless you have picked up there are lots of people in Westminster who would rather like for the bank to be cutting interest rates. And a lot of people tell us all the time, particularly within the government, that's what the bank needs to do. Do you think that kind of thing, there's always been a bit of it, but it does feel like there's more of it now. Is that fair? Is it helpful? Is it unhelpful? And what do you do to kind of maintain your independence in the face of that?
Well, as you said, Ed, we are an independent central bank. We have a very clear remit. We exercise that remit. It's our duty to exercise that remit at all times. And I hear the same things you hear. You may hear more of them, but I do hear them. But let me be clear. When we are sitting in the room as an MPC, as a committee, we never discuss politics. That's not a subject that we discuss. Our job is to take decisions, consistent with our remit. Our remit applies at all times. So it isn't a consideration in that respect.
Thank you. Phil Aldrich at Bloomberg. It's a bit of a technical one, I'm afraid. There's been a bit of a surge.
So you're already looking at Dave, I see.
Yeah, I did click there. There's been a sudden surge in the demand for your short-term repo operations. And I just wondered if that signals that banks are facing liquidity problems and whether this would have any bearing on whether you would bring QT to a close earlier. And also, if once you do start cutting rates, if you're operating active sales under QT, doesn't that make your policy incoherent?
Well, Dave will come in. Let me just say a word at the beginning. QT is going, the sales process that we're going through will bring the level of reserves down to its equilibrium level. And the equilibrium level is the level that is needed, both from a point of view of operating monetary policy, but also, and this may be, in a sense, the higher sort of bite, as it were, for financial stability reasons. This is, in a sense, the highest quality liquid asset that the system the banks can hold. Now, we can't tell you what the equilibrium level of reserves is. That's a level that will emerge because it's for two reasons. One is actually because historically we haven't been in this position. You go back before the financial crisis, the level was clearly too low, and also because it is very endogenous. But we will hit that level, and we will then have to obviously take decisions on what we do thereafter in terms of managing the Bank of England balance sheet. Now, the short-term repo facility, it's a classic central banking, open market operation, really. We deliberately put it back in place before we started QT, for the reason that if we start to hit the equilibrium level reserves at a higher level than we might have imagined, obviously we don't want the short-term interest rate going up as a result, and that puts us out of line with monetary policy. So it's there to be used in that sense. It's there to be used. Now, I don't think, therefore, we can necessarily conclude that the increase that we've seen denotes that we are at that point, because there are other reasons that banks may well use it. But that's the mechanism. But I'll hand over to Dave to
let me
take up the rest of the press conference, really. Probably talk about the rest.
Well, I'm sure you don't. I do feel a speech coming on, but I'm sure no one wants that, although Phil probably does. Just from where Andrew's taken the story, I think we, as Andrew said, we put in place the STR 2 years ago. It was our latest way of saying we're open for business, for people to come to us as sterling monetary framework participants to borrow, 1 week, 1 week money on that facility. The point being about what's happened recently, I think we are comfortable that we're not at this new equilibrium at all. We did see increased usage last week. For me, as a person who has to sort of explain to the MPC, but also, explain to all of you what's going on, I thought that usage was really exactly as intended and as you would expect. I mean, the repo market's been functioning well over the last few weeks. There are known factors in the market as to why rates were rising. There were both demand and supply factors in the gilts market. There was a very large gilt redemption. There was an upcoming syndication. Also, we could see moves in FX swaps were bringing, different players into play and some month-end effects. So you had a whole set of things going on in this quite specialist area. And what we've seen is that repo rates have actually fallen back from the peaks they were at, which, again, to Andrew's point, it makes you think the STR is doing its job. There's always going to be stuff happening in the repo market, but the STR is doing its job. We're not seeing some, ratcheting up more in these rates that might make you think, oh, right, so reserves are becoming a bit scarce. We are getting closer to that equilibrium point. So that's where we are. Just on your other point, just to reassure you, I was completely comfortable when I was making my vote to reduce bank rate to continue with the QT programme in the background. We committed to that 100 billion last September. That's been working well. I don't see the contradiction at all that you were implying. We always said that QT was in the background and was about the balance sheet and getting back to a more normal place on that, and that bank rate was going to be the active tool.
Yeah. That's a really important point. QT is not designed to be an active instrument of monetary tightening. And if that means anything at all, it means precisely that it can continue to trundle along while the overall level of monetary conditions is determined as necessary by ups and downs in bank rate. And that's what we said right from the start. Indeed, we set out that approach many years ago. Second point I make in that respect is, as long as you believe, and I tend to believe this, that the vast majority of the effects of asset purchases and sales, which, by the way, we think can vary over time, are transmitted via the prices of financial assets. And as long as we make a forecast based on those same prices, which is what we do, we will take into account in determining the level of, in order to determine the appropriate level of bank rate, any effects that QE or QT are having. So I don't see any tension or contradiction here at all. And as I say, we've set that approach out in quite a lot of detail on two different occasions now. By the way, just to say that after, I'm leaving soon, but the MPC, the future MPC, will, I think, as it said, the default position is reconsider the year ahead or set the year-ahead target for sales every September, is it?
Yeah, we have the annual review,
Yeah.
which will be getting going soon, and we'll set it in September.
Yeah.
Sue and then Steve, please.
Hi, Sue Chan from The Telegraph. Just looking at this box you have on developments in the market sector, is it fair to say that economic growth, employment, and the pretty chunky wage growth upgrade you have in this forecast have been driven by growth in the public sector rather than the private sector? And what are the implications of that? And if I may, you touched on the minimum wage. Are businesses citing it as a concern when you talk to them?
Well, let me start. I think Ben will probably want to come in. I mean, one reason we thought it was useful to include the box was because we did see last year some divergence between the market sector and total GDP, which, of course, the residual, as you say, is the public sector. Now, that's important because, in a sense, price formation goes on in one part of the economy. Activity and, however, activity and sort of, if you like, pressure on the sort of the supply-demand balance obviously comes from the whole economy. So, separating these two things out is quite useful, I think, to actually illustrate at a point when you do see that sort of divergence. Ben may want to say more on that. On the minimum wage, or national living wage, I should say, it does get talked about a lot in, certainly my regular tours around the country. But I would just emphasise the point I made earlier. I think it's important to add to that point. The question I always ask businesses when we're discussing it, which is understand the headline impact, but the important question is how you're responding to that in a number of respects. One is obviously what it means for demand for labour. Secondly, are you to what extent you're passing it through into prices, and to what extent conditions are enabling or limiting that. So those are in a sense, the really key questions, certainly the ones I always ask when I'm out and about. And I would say, interestingly, the sense I've been picking up for some months now, actually, is greater doubts about passing it on. But we'll see. I mean, that's, going back to some of the earlier questions, when you say, how do we process evidence and what do we look for, that's the sort of thing we're looking for.
Oh, well, I mean, generally we approach things at the level of the aggregate economy, and we have projections for aggregate demand and aggregate supply, but it can matter when there are some divergences. As Andrew said, it is the market sector that sets prices. The public sector can still matter, but strictly speaking, it's the claim on resources that the public sector makes that matters more than its output. So it's not so much whether public sector GDP goes up or down, it's how many people is it employing, I think, is the more important question for us. So on the whole, it's reasonable just to look at everything all together, but there are occasions when you get divergences, when you should think about these nuances.
Steve, yes, just there.
Steve Sedgwick, CNBC. A couple of quick questions. You've all put great store in what the agents and their contacts have to say, so I got to page 62, you'd be pleased to know. Box E, even further than Dave's box E. And actually, what I read was quite worrisome. Contacts have been surprised by the weakness in consumer spending on goods, despite that robust jobs picture, despite that robust wages picture. Subdued consumer demand is widespread across retail and services sector in an economy that relies on services and retail sector. Underlying demand has weakened. This is what really worried me, though. Not the fact that we're eating at home, that's fine. But contacts are unsure as to the reason. That's got to be quite worrisome that such a large trend has been seen in the first quarter, but they don't know why. And my second question, following on from Ed's as well, I know you're independent. You put great store in it. You don't talk about politicians. Absolutely not. Why would you? But the fact of the matter is, you're running into a rate-cutting cycle amidst what will be a general election, which could interfere with your decisions, potential, or come adjacent to your decisions in September, November, possibly December. That's going to make things more tricky for you. Thank you.
Well, very clearly on that, I'll come back to the first question because I think it's a really interesting one, but very clearly on your second question, look, we will take the decisions at each meeting that are consistent with our remit. I mean, that's our job, and we will do our job. Now, your first question is really interesting. So, we often, as you say, we talk a lot about the agents for good reason. And we often say, well, sometimes we get, slightly different messages. And you've found a very good example of this. So at the moment, I would say, obviously we've got a GDP number coming out tomorrow morning. We've, in a sense, I said something about it in my remarks. It's set out in the report. We think it's going to be a bit stronger than we thought it was going to be, and that it will offset some of the weakness we saw at the end of last year. We've also got survey evidence, a lot of survey evidence, which is tended to be telling a more positive story. We've got retail sales, which has been tending to tell a more positive story. But you're right to point out that our agents are saying to us, that's not quite the story they're hearing. They're hearing a bit more cautious story from their contacts consistently. So we have to balance. We have to balance these things. I mean, it's part of our job, but it's a very, very good example of why we have the agents and put so much emphasis on them, because occasionally they will come in and say, you know what, we're not quite hearing that story.
Chris and then Ashley.
Chris Giles from the Financial Times. Governor, we care about the market interest path not because of what's going on in the city, who's making money and who's losing, because it prices things in the real economy, particularly mortgages. It's gone up quite a bit since your February forecast.
Yeah.
First of all, how comfortable are you that when you're talking about rate cuts, mortgage rates are rising? And secondly, could you therefore sketch out what would be a reasonable scenario for interest rates consistent with hitting your target on a sustained basis?
Well, on the final point, Chris, I mean, as Ben said earlier, look, I mean, we make observations on this. We deliberately don't set out paths in that sense. Now, look, as you know, in terms of the work we're going to do to consider Ben Bernanke's report, we're going to think about all these questions. We're not going to implement bits of Bernanke piecemeal, though. That's what I would say. On your point about what's happened since February and mortgage rates. Look, I come back to what I was saying earlier. I think it is, it's evident certainly from the work our staff have done that the US market has been having more impact on our changes in our rates when they do the decompositions than not. It always has some influence, but it seems to have had more influence recently. I think we've seen a bit of decoupling of that of late, but it's still overall, if you take, as you said, February to now, that's the story. Now, I'd come back to what I said earlier. I am raising a question about that because our inflation dynamics, I think, are different, as I said earlier. So I think there is a question around that has to be put.
And if I can just add, I mean, I remember answering a very similar question to this back at the February press conference when I talked about the declining trend in mortgage rates. They come down a lot from their peak, sort of late summer last year, and the question was around, was that going to continue? Obviously, because of what's happened to the reference rates for the key mortgages, the reference rate is the OIS rate, as we show in chart 2.8. That has moved up relative to February. That has taken mortgages, the key mortgages, a bit with it. However, they're still a long way down from their peak. And also, I think it is important to say that compared to when they started to rise through last spring and summer, from the autumn 2022 peak around that time, that was when we were getting more and more concerned about persistence in inflation, and that was being reflected in our monetary policy decisions. We are in a different context now. I mean, the MPC hasn't changed rates today, but Andrew's set out very clearly in his opening remarks, we've set out in the minutes that we think the risks from persistence are receding. So I wouldn't want you to draw the conclusion that somehow we're on a sort of another, big upward lurch in mortgage rates, but they certainly have started to go up a little bit compared to the strong downward trend that we had before.
A couple of things. I mean, first of all, this is a fact of life. As Andrew said, the correlation with US rates is slightly higher. over recent months. By the way, pulling them down in the autumn and the early part of this year before putting them up again. So it goes both ways, but it's always there. It's a fact of life, and I don't think that fact would be changed if we were to publish, quotes, a rate path. The second thing is that, we're a committee of 9. I'm quoting here from the paragraph 21 in the minutes. And that it's hard to get one single answer. I think you get different answers if you talk to different people on the committee. There is, quotes, a range of views amongst the majority regarding the risks around the assumptions on persistence embodied in the May CPI projection. There's also a range of views, and this is relevant for some of the earlier questions, about the extent of the evidence that was likely to be needed to warrant a change in bank rate. So I think it's difficult under those circumstances to say, here's exactly what we're going to do, even in a conditional sense. Christo, it is.
We're not asking for that.
No, indeed.
Well,
no, but I'm saying there isn't one. That's what I'm saying. And if we were ever to publish a rate path, my expectation from the outside, as I'd be, is it would be some algorithm. It would not be a best collective judgment. It would say, take the forecast and let's work out, quotes, under certain conditions, what's an optimal path. It would not be a best collective judgment. And that's the point I'm trying to make. So it's possible to do it, but my own view is it wouldn't have much bearing on the extent to which US economic news, US moves influence our own curve. It's a fact of life as a small open economy that our rate curve will get buffeted around by these things.
If I could just finish on one point, because you've written a lot on this, Chris, and been very insightful on it. I think it's important with conditional forecasts that we don't take the approach of saying, well, we must always find a way to get it back to 2% at the end of the... I mean, if our best collective judgment is that with this set of conditioning assumptions it's 1.6, then we should say so.
Ashley. Hi, Ashley Armstrong from The Sun. Dave, you mentioned that we're going to have to wait until your next speech to find out exactly why you voted for lowering. But aren't you self-conscious or worried about the fact that your speeches and MPC speeches have become so extremely market-moving, where we're really seeing the market move depending whether you think that it's soft or looser or tighter, and it feels like those are becoming as much watched events as the actual MPC events. And then the second one, I suppose, would be also on the Governor's comments about conditional assumptions, but also this obsession with the 2% target and getting it down to that. Given that actually next year you think that inflation will be higher than the 2%, can you give any reassurance to Brits that you aren't going to be raising rates again to bring it back down, so we'll end up on another roller coaster? Thanks.
Andrew's looking at me, so I'll answer. on the point about speeches, I mean, it goes back to what Andrew and Ben have both said, and one of the strengths, I think, of the setup in the UK, we have 9 members who each have a vote, and we're publicly accountable for that vote. And at times there will be, differences of genuine assessment as to where inflation's going to go, given that that's our remit, and we have to be publicly accountable for that. So I think it's a strength that we have to communicate our views. Swati and I have got, we've been given, we could have had more, but we've got a whole paragraph that sets out our views. We'll expand on that. I gave a speech a few weeks ago that did move markets a bit, but equally, it was important. We'd said in March that there were a range of views on this issue of the risks to persistence, and it was important, I think, as an individual member with a vote to be accountable for my view and to set that out. And at times when people, reasonable people on the committee, we can disagree on the assessment, then we will have to communicate that. But I don't see that as being a fundamental cause of volatility. I see that as being important communication to the markets, to steer the markets on the range of views.
By the way, I make no apologies for being obsessed with the 2% inflation target?
Well, on your second question, the remit is 2% sustainably in the medium term. That's important because it means we have to look at that horizon, and but very important, it gives us, or requires us, and gives us the scope to look through temporary ups and downs. But we have to obviously analyse them very closely to get to the point where we look through them, but it gives us the ability to do that. So I would just reassure your readers at this point that we do that. I think we've got a forecast that we were just discussing in Chris's question the end point of the forecast. So I would not want to put overdue emphasis on the sort of the fluctuations to get to that point. I mean, they're interesting. We have to tell the story behind them. We have to understand them, what they might lead to, but we should not give them too much significance in that sense.
Okay, we've got time for two more, so we'll go to Isha and then up at the back there.
Hi, Isha Nelson from the New York Times. Just a quick question on the labour market comment. You say, it's continuing to loosen, but it remains relatively tight by historical standards. So I want to check, how much of that tightness has been surprising, maybe? And is it a reflection of what you've been saying about queries around the data and being hard to judge participation? Or is the labour market acting in some way that's actually quite unexpected?
Well, we were talking about, obviously, the issues with the labour force survey earlier, but I think it's important to put that into context. I think whichever way you look at the labour market, and we look at, obviously, as Ben was saying earlier, we use a lot of other data to, in a sense, get to a judgment on it overall. We are around full employment, frankly, at this point. Now, if I go back to the agents for a moment, because there's another interesting subject, I think one of the things that I've certainly picked up for quite a while now, actually, is firms saying that they were retaining labour. One of the comments I got quite a lot, and you can put this into the context of the vacancies to unemployment series that we've published a lot, is that their concerns about the difficulties they had had with hiring labour meant that they were very reluctant to release labour. Probably more reluctant. I mean, it gets called labour hoarding often. That's a slightly pejorative term, but that's the word that often gets used. Now, what that would suggest is that the labour market probably looks a bit tighter, therefore, than you might expect. But of course, the judgment we then have to make is, as we see an expansion of demand in the economy, how are firms going to respond to that? Because arguably, they've got labour that can be used to meet that expansion in demand. But as you'll see also, I mean, one of the other things we have done over time is that our view on the sort of the path of unemployment has changed as well. It's now considerably shallower than it was in the past. And I think, frankly, pretty much every other forecaster of the UK economy is in the same place, actually, on that.
Straight up at the back.
Let's give it a try.
Oh, thank you.
Thank you, Suban from Reuters. Hi, Governor, this question for you. Dave just briefly touched on there being a range of views among the 7 MPC members who voted to keep rates on hold.
Could you I'm sorry.
Sorry, Suban from Reuters? Hi.
Yeah.
Sorry, Dave's just briefly touched upon there being a range of views among the 7 MPC members who have voted to keep rates on hold regarding how much evidence is likely needed to be sure persistence in inflation is fading sufficiently. Where do you stand in that spectrum of views, and could 2 months of favourable data be enough to change your vote? Also, a follow-up question. The BOE minutes talk about potential currency implications from divergence between US and European growth and monetary policy. How much more scope is there for sterling to weaken against the dollar if the BOE cuts rates before the Fed? And how much of a bearing does this have on a rate cut? Thank you.
Well, I mean, if you don't mind me saying so, the first question's a nice one, but it's slightly another variant of the are you going to cut in June question. I think we've sort of answered that question. There is a range of views, and I'll just refer you back to the point I made early on. We've made quite an important adjustment to the forecast in terms of our views on the scale and persistence of the inflation persistence point. It's been substantial subject of discussion in this forecast round, and we've come to the view that the inflation persistence is probably going to recede slightly faster than we assumed. But I did make the point very deliberately in my opening remarks. There are different views on this amongst the MPC members, and I'm sure you'll hear different views in the comments that individual members will make in the coming period, and that's true. There are different views. So if you had to sort of characterise what's that sort of range of views amongst those of us who voted to hold rates, I would say probably the question of to what extent we're confident that this receding picture of inflation persistence is sort of bedded in is clear near there. On the exchange rates, I mean, one thing I would say is we've obviously seen quite a shift in markets' view of the path of both US monetary policy and other people's monetary policy. The exchange rate, in a sense, is obviously the relative price. So to a considerable degree, I think that's already priced in to the degree the markets have taken that on board. We follow the exchange rate closely, but actually, and I think we have this in the section of the NPR that comments on the conditioning assumptions, the exchange rate actually has not been one of the ones that has moved particularly substantially. And obviously the market prices all of this information in.
I just want to squeeze John Paul in.
Yes.
Thank you. John Paul Ford from the Daily Mail. A couple of things. One, I'm going to try again on the rates. Neither fait accompli nor ruled out for June suggests kind of 50-50, some might think. Does that imply that August is a bit more than 50-50, that we might think that at least by the summer that those chances are even increased further? My second question is about regulation. The naming and shaming proposals by the FCA. First of all, if you have a view on those proposals, lots of people do have strong views on those proposals, but also on whether it's appropriate for the government to have intervened on the proposals by an independent regulator, particularly as there's a background of another proposal on the equality rotors, an FCA and PRA proposal, so it does impact the bank. So do you think that it's so your view on that, and whether it's appropriate for the government to be intervening as it is doing, and whether that's a worry for you?
Right, two very different questions. Look, I think, that, if you don't mind, I think the first question is a nice try to sort of reintroduce the "is it June" question again. And I'm honestly just going to restate what I think all three of us have said, which is we take it meeting by meeting. And that's what we will do. Just remind a point I think I made in my opening remarks, which is we will have two full sets of data between now and the June meeting. Sometimes we get one set between meetings, sometimes we get two, because we have 8 meetings a year and there are 12 sets of data. There'll be 2, so we'll have more data before the next meeting. Look, it's not for me to, obviously, I'm a former chief executive of the FCA. I'm not going to comment extensively on the FCA. But what I'll say is this. Because I'll say it because it does actually relate to the latter part of my own time there, and one of the cases that gets cited and actually came out of the Public Accounts Committee as the British Steel case is from my time. I think what needs to be, in a sense, debated in this and brought to conclusion is a tension, and the tension is this: it's between the principle, which is important, obviously, of innocent until proven guilty. But the problem that if a regulator is in, and this could, by the way, be the PRA. It's not in this case, but it could be. I mean, PRA does less investigation because prudential regulation is different, but it does from time to time, and that's obviously part of the Bank of England. If an investigation is going on, and during the course of that investigation, and the nature of these things, they can take time. Nothing can be said about that, then the risk is obvious that some mis-selling is, and therefore, some mis-selling to consumers is going on. Now, so I'm not part of this debate in the FCA context anymore, but it's relevant to, say, us as a regulator. I think we need to get back to how we can reconcile those two, potentially conflicting principles, rather than sort of, in a sense, sort of. Say you can't do this, you can't do that. There is an issue there. then we can think about all the ways we could possibly solve that tension. That would be my, I hope it's a helpful contribution to the debate.
Thanks very much, everyone.
You've been listening to the press conference, which is being held just over the road from where I'm standing right now at the Bank of England, being led, of course, by the Governor, Andrew Bailey. A recurrent theme throughout the press conference, as you probably picked up at the back end of it, talking about this idea, is June a live meeting in terms of a rate cut? And as if right on cue, the markets are pricing basically a 50-50 call on that meeting. Now, that has swung slightly more dovish than maybe we were coming into the meeting, but not significantly. June-August looks like it's being the two meetings that are most likely. The other thing that I think stood out in some ways was the bank being puzzled about A, the data it's seeing, and B, the way that the market is pricing its rate path in accordance to what it's seeing across the Atlantic with the Federal Reserve. And clearly the Bank of England is puzzled as to why it is seeing that lockstep by the market when it comes to those two central banks. The other thing is the data as well. The data are interesting at the moment. The data are in some ways confusing what is happening in the labour market, what is happening as well with the agents and what they are signalling about how people are feeling right now. All of it's slightly contradictory, and it points to a picture of a little bit of confusion as to where exactly the UK sits right now in terms of its economic trajectory. We get GDP data out tomorrow. The Governor indicating that he feels that will see a slight tick higher. Now, that raises questions about where rates go from here. Let's talk about how markets have reacted to the data that we've seen. As I suggest, we have seen now the market pricing in a 50-50 chance of a rate cut coming through from the Bank of England, 25 basis point cut coming through in June. As you can see, equity markets are a little bit higher. The more rate-sensitive areas of the market are a little bit higher. We have seen a bid back into the front end of the curve. Sterling has reacted very little, I would argue, during this process. But you have seen a move at the front end of the curve. Let's digest what we've just heard. John Stepek joins us now from Bloomberg Wealth. John, a number of things kind of stand out within what we've just heard from the Bank of England. But I want to kind of take what we've just heard and also look forward. We get the GDP data coming out tomorrow. The Governor's pointing to a re-acceleration in an economy that is now primed for rate cuts. Can you pull that all together for me? How big a risk are we running in terms of aggressive rate cuts here? Is that ultimately what we're going to see?
I mean, I don't see us getting aggressive rate cuts. Yeah. I mean, the UK is now rebounding from what was a very shallow recession that, who knows, in the future may still be revised away. And so far, most of the kind of macro data has been surprising on the upside in the UK. So, the PMIs, for example, have been pretty positive, particularly services sector. And so we seem to be coming out of whatever we were in. And then it's kind of weird in a way to think, oh yes, but now rates are coming down as the economy is getting stronger. But obviously that's because it's all about inflation. And so the hope is that we'll get back to 2% or 2.1% come the next inflation figures, which are out next month. And they're expected to show us going down to 2.1%, which is mainly down to the energy cap coming down. And from there, we're meant to kind of puttle around 2% for the rest of the year. And so the bank will feel that it's okay to loosen monetary policy a bit. But, obviously the kind of markets have completely changed their expectations from December. We were thought to be going down to 4% by the end of the year back then. Now we're looking at maybe down to 4.75, 4.5 at a major push.
So if I'm looking to take out a mortgage, it's been a bumpy ride over the last few months. And I'm wondering after today's press conference whether I have more clarity as to my understanding as to ultimately what risk I'm running taking out this product versus this product.
Well, I mean, from the mortgages point of view, all that instability has passed to an extent. You're now getting a sort of sense that we're going to get roughly kind of 4.75% by the end of the year for the markets, for the base rate. And the 5-year swap rate, which is basically what your mortgage is priced off, is kind of stabilised around that area. So at the start of the year, you could get a 5-year best buy fix for around about 3.8, 3.9%. That has since ticked up to around about 4.2, 4.3%. So that's a tightening of policy for consumers, effectively. And one thing I did think was interesting about that press conference is that they highlighted at one point that their agents have been a little bit gloomier than the data shows. They're kind of saying that, private investors, individuals are kind of holding back, both on the services and the goods side. And when you think about it, it's possible that that's down to precautionary saving, because people in December were thinking, interest rates are on their way down, and they're on their way down fast. And I think at that point, a lot of normal people probably thought that we were going back to the 2% rate era. Now, I don't see that happening, potentially even in our lifetimes, actually. But the point is, I think that message is starting to get through to people now. Your mortgage is probably going to be around about 4%, and you're probably not going to get less than that this year. And so people are having to refinance, have probably redone their sums in their heads and thought, actually, I maybe need to save a bit more than I expect. Now, with the same for anyone who's trying to buy a house at the moment, it's even harder. You're having to save more money for a deposit. You have to save more money for your mortgage. And so I can see that perhaps that would have driven a little bit of caution in the first quarter, and that might be what the bank's agents are saying.
Looking further ahead, just kind of dwelling on that idea of caution, do you think there is a belief, do you think there's an understanding that rates are going to come down and stay down? Because if they come down and stay down, life becomes a lot easier, you can manage that risk. How big a danger is that they come down and inflation, which feels like it's being put to bed right now, reignites? You've got an economy that doesn't, to your point earlier on, feels like it's already bottomed out. You put a bit more kind of fuel on the fire with, 100 basis points worth of cuts. Is there a danger that the Bank of England is going to be, 10 weeks, 12 weeks, 16 weeks, 20 weeks down the road going, actually, the economy is responding not with a long and variable lag, but with a short and quick lag, and here we go, we're going to have to deal with this and maybe dampen it down again? I mean, it's quite possible. I do think the amount of faith we have that inflation's that has been tamed, and that it was fundamentally kind of a very long period of transitory inflation is perhaps misplaced. I mean, we've been lucky so far because the oil price has been pretty well behaved given what's going on in the Middle East. But at the same time, you've got the economy kind of bouncing back. You've got the government has actually cut taxes for a band of workers who have quite a high marginal propensity to consume, and for anyone who's not interested in econo speak, that just means that they're more likely to spend it than people with lots of money. So you might find that the economy reaccelerates faster than expected later this year. And we're already, even on the banks, forecasts, we're still above 2% for the rest of the year, pretty much. If you start nudging back up to 3%, it becomes increasingly hard to justify this idea that rates are just going to keep getting cut from here. So absolutely, I mean, I think it's surprising the amount of faith, actually, and the amount of confidence we have that inflation's been beaten. What does this mean for stocks, UK stocks?
Oh, they're going to go up. I mean, UK stocks are inexpensive relative to the rest of the world. The UK stock market has been getting an awful lot of attention recently, both from a kind of complaining about how we need to boost our capital markets, but also from the fact you get this big bid coming in from BHP for Anglo. Certainly from the way analysts are talking, I get the sense that the attitude towards the UK stock market is turning around. And honestly, even if the economy just kind of bumps along and interest rates broadly follow the path they're on, I would be bullish on the UK market from a cheapness point of view.
FTSE 100, let's just park that to one side because it's kind of half and half in terms of its components and how it's exposed to the rest of the world. But for the 250, I can draw a line between interest rates and pricing.
Yeah, I mean, you can to an extent because obviously, the 250's got a lot of rate-sensitive sectors in it. You get your commercial property, you've got your house builders, you get retail as well. But the other issue is that they are trading at quite a big discount to the rest of the world. So if attitudes, if you like, change from... I mean, for example, the Bank of America survey of global fund managers every month has got the UK at the bottom as the most detested stock market in the world. If that changes even a bit, then you could see inflows coming back in. And so to an extent, I think as long as the economy is kind of okay, you don't need to worry so much about the macro, even for the 250.
Great to see you, John. Thanks very much. Bloomberg's John Stepek. OK, let's talk a little bit about what's coming up a little bit later. We are going to have an interview with the Governor, Andrew Bailey, following the press conference we've just heard. We'll get all of that a little bit later on once that interview has done. In terms of what else we're going to be watching, I'm going to hand you back in just a moment to the surveillance team. Claims are a little hotter. US jobless claims, weekly data, maybe showing signs maybe that the labour market is beginning to show a few little cracks. Anyway, let me hand you back to the team over in the United States. They'll take you through the rest of the day. This is Bloomberg.
We got jobless claims data moments ago. It came in at 231,000. The estimate was 212. That is an upside surprise, the wrong kind of upside surprise. And off the back of it, equities erased the morning's losses. We are just about unchanged.